All right, Mr. M.V. Gowtama joins us now to walk us through the fortunes ahead for BEL and how we should look at the new large orders which they've really got from the Ministry of Defence. You've signed a contract with the Ministry of Defence for 7 large Akash missiles for Air India. Is this an annual maintenance contract, or this is a contract which is going to be more like a structured contract? Can you share some details? How are you planning to execute it?
This is for supplying 7 squadrons of Akash missile system to Indian Air Force. It is a comprehensive turnkey contract. It has got establishment of some of the infrastructures required in the newer areas, as well as maintenance of the equipment beyond the warranty period also. So the entire contract value is prior negotiated and fixed, and we are very happy that we were able to get this order not much later.
What is the outlook? What is the overall outlook on the order book? Can you share with us the breakup both for the non-defense and the defense orders? What is your order book guidance also for FY20?
We initially gave guidance for the current financial year that anywhere between 13 to 15,000 crores of orders will be acquiring. So today already we have acquired about 9,000 crores of orders during the current financial year, which includes the Akash 7 squadron order. So we expect the other programs to come to us before March, and that will add up to about 12 to 13,000 crores for sure. I'm hopeful at this point of time that we'll be clocking the order book. So the other programs we are looking at this point of time are like phase 2 of coastal surveillance system and a large GW program for Indian Army and etc., for which the negotiations are underway, and they can be closed anytime. Now the Homeland Security and Smart City business unit today has got orders worth about 5,000 crores, and we are also foreseeing good inflow of orders for the smart cities to come in future also. The overall order book today, the LRSAM program, we have about 15,000 crores of orders, followed by major order of Akash, and then we have large orders for the electronic equipment for different chipsets, and this is the in turn what I can explain to you at this point of time, our order book.
Okay, how do you plan to tackle the rise in competition from domestic private players as well as global defense majors? And the government policy on indigenization, has weakened, which will lead to higher imports. Is that going to be a negative for you, or to what extent do you see an impact of that?
The government stated policy in defense is to make defense more competitive, to bring in Indian defense industry to defense sector in a large way than what it is today. So government also has planned a strategic partnership model for the Indian defense majors, and this is going to be a game changer as far as the defense sector in India are concerned. The foreign players are also establishing their own companies in India. So certainly the competition is building up much faster and much larger than anybody could think of in the defense sector. However, the role of BEL, both with the Indian platform manufacturers as well as the foreign platform manufacturers, as well as the public sector enterprises which are doing the platform manufacturing, I hope we will be able to maintain our market position and our leadership in supplying the electronic equipment, sensors, combat management systems, command control systems, etc. And we will be having a steady growth rate even in the coming years.
Okay, tell us more about your plans to increase the share of high margin service income to 15% of sales by FY22. We're at 10% currently. Where would this take your overall margins?
The overall margin depends on the product mix and services mix in a particular year, and certainly if the product mix has got a large number of equipment where in-house value addition is there, the margin is going to be very high. However, if the product mix has got TOT based projects or work share based projects, they probably with lower value addition, the margin also will come low. We are trying to visualize for BEL a product and service mix which is going to sustain our margins, and we expect EBITDA margins of 17 to 19% continuously to be maintained even in the coming years. And these margins will certainly cross 20-21% once we make more revenues than what we give as the intended or a target for a current financial year. So the more we do, certainly our margins are going to be much higher.
Sure. Mr. Gowtama, you plan to develop alternate non-defense revenue streams as well, like smart cities. You're targeting a steady flow, as we understand, of about 3,000 to 4,000 crore rupees worth of consumable orders as well annually. How much headway have you made in this project, and what kind of capex is slated for this?
What we are not investing specifically into the technologies required only for one niche segment. In BEL, we invest Capex, which addresses largely both the defense as well as non-defense requirement. So today, the requirement of homeland security is overlapping with the requirement of defense. And hence our Capex projects, whatever we have taken up, they are going to be beneficial both for homeland security as well as the defense projects.
Right. Your role in services contracts is also growing, Mr. Gowtama. As you mentioned, to double digits. What kind of order inflow do you expect from services contracts?
Previously, if we see 4-5 years back, our services share was pretty low, and mainly we are seen as equipment and spare supplier, and services were done by services themselves, the armed forces themselves. But of late, many of the contracts are coming with annual maintenance contract as part of the bidding process itself, as part of the initial RFP itself, and hence our role in services is increasing. Today, services are fetching us nearly a double-digit figure, and coming 2-3 years, we expect our services to grow to about 20-25% of our revenues. So in these services, again, the margins are dependent on the performance of the service contract. Today, if the availability of the equipment is guaranteed for more than 95%, you are paid 100% of the service charge. And if the availability of the equipment drops below 80% or 75%, then you may not get anything at all. So this type of challenging scenario, we have to perform and then only we will be able to get good revenues. So as long as we maintain the availability of the equipment to the satisfactory level of the user, I am sure services are going to fetch us with good margins, and certainly we will be able to maintain the overall margins what we are giving as guidance figures.
And over the last few years, other income has continuously reduced as well, and analysts are seeing this trend continuing given the currently strained government finances. You know, that could further stretch your working capital. Are you looking at perhaps, do you see a scenario where you venture into becoming a net debt company? Any other income component at this point? Just share with us, how you're looking at the situation currently.
Other income component is the good one-time dividends what we were getting from our joint venture companies. In the last 2-3 years, we were able to get a couple of times good one-time dividends declared by those joint venture companies. So they have fetched us other income. Otherwise, as you have correctly pointed out, the interest income has gone down drastically. Today we do not have much of cash balance in the bank that earns us interest income. So the working capital we are able to manage as on now without going for a loan at this point of time. and we expect the working capital to be tighter in the coming days also, and we will be always required to be on our knees and ensure that we have good fund collection happening to meet the requirements and manage the company. As on today, we are a debt-free company and manage the company debt-free even in the coming time. So other income, I don't expect to give any significant change in the coming years, and in fact it will be coming down if the joint ventures can't give us extraordinary dividends what they have paid in the last 2-3 years. Then we may not get other income even to the tune what we were getting earlier.
Okay, but you have some major plans laid out for the year. Tell us a little bit about the business opportunities in the electronic space, solar energy, smart cards, telecom.
Already the Capex is going on, some Capex plans are going on. Coming to space, we wanted to create a separate strategic business unit dedicated for the requirements of ISRO, and towards that we have acquired land near Devanahalli Aerospace Park, and we are going to shortly start building a unit there with the approval of the board. We need to get the approval, but once we get the approval, we will start it. That business is going to grow up. We expect the requirement of ISRO to be around 600 satellites in next 5-6 years of time, 5 to 8 years of time maybe. So that's going to be a very good business. Then smart cards, we are looking to participate in a big way in One Nation, One Card project. We already have got the fare collection gate for metros, which we are expanding it to the other modes of transport. And hence, the moment the One Nation, One Card program grows bigger, our business share in that is going to grow bigger. Then solar, we are already manufacturing solar cells and modules from wafers. We have 20 megawatt capacity, and we are leveraging our solar manufacturing by doing projects, competing in projects, and we would like to expand our solar business by working closely with other niche players in the field. So we have got business strategies and plans worked out for these business areas.
Okay, Mr. Gowtama, we'll leave it at that. Thanks so much for taking the time out and speaking with us today.